Good morning all, good afternoon, wherever you are today, and thank you for joining our webinar this morning. My name is David Britton. I'm a tax partner here at BDO in the UK. I specialise in tax for fintechs, banks and crypto, and I've had just over 27 years in the banking and fintech business, a combination of both in-house at HSBC and practice here at BDO and at EY. So I've got a lot of experience in this sector. But today I will be joined by a number of presenters who will introduce themselves as we go through. But the presentation today is really just to give you a high-level view from a fintech's perspective about doing business in the UK. Now, a number of you might be in the UK already, or a number of you may be considering coming into the UK. This fintech series is a series that's been run by BDO across the global FS practice, so the financial services practice, and it's the UK is the first of a series of countries of doing business in, and particularly just looking at fintechs. Today we're going to cover a wide variety of subjects. I'm going to cover just some general high-level topics that I see that are impacting fintechs as they start in the UK. Then we're going to cover VAT. We're then going to cover tax incentives, and then last but by no means least, we're going to look at tax incentives. So I'm joined by Aditi Hyatt today, who's going to lead on the VAT. Unfortunately, when you see the slides, it was going to be Vicky Weston, but she's unfortunately ill today, but ably assisted instead by Aditi. Carrie Rutland will then take you through our tax incentives, and Martin Callahan will take you through the tax risk management as we see them and the impact that we have for fintechs. Just a little bit of housekeeping before we get into the main presentation. The webinar is being recorded, but as your videos will not be seen, etc. So hopefully you won't have any concerns there. It's been recorded so that we can share it around after the presentation. Please do ask questions. There is a question, there's a Q&A box at the bottom of the Zoom screen. Please put in your Q&As and we'll look to answer those. Do them as we go along, and we'll either do it at the end of each presentation, or we'll look at them all at the end. Today's presentation is going to be about an hour. We'll allow time for questions, as I say. Each session will last around about 10 to 15 minutes. So hopefully, please be interactive, ask the questions, as I say, but really it's really to get you thinking about some of the issues that we really see impacting the fintech sector. Reese, if you could flick on. So thank you, Reese. So the first thing I wanted to talk about is really just to give you a bit of a flavour about what I see when fintechs are starting in the UK, and I think the main thing that I see, and you're probably all acutely aware in the sector, fintechs are different than your archetypal businesses that they might be coming from in terms of the financial services sector. Your old style, if I want to call it that, in terms of the banking world, they would have developed themselves and in a particular country, grown well in that country, and then looked to expand. However, for fintechs, you're so entrepreneurial that you start in one, and just by the very nature, you start in one country, but that's not it. You start in multiple countries and grow really, really quickly. So a lot of what I'm going to talk about here is really about just don't forget the basics, and that's really the highlight that I wanted. If you want to take anything around from here, is don't forget tax and don't forget the basics of tax. It's fundamental in terms of getting things right, and I do see it quite often that if fintechs get it wrong, there's quite a high cost. However, if you get it right, the tax can be a benefit, which we'll come on to later, particularly in Carrie's section on tax incentives. So some of the themes I wanted to pick up on. Now I've got this slide here, just in terms of what you should be looking at, and it's really about looking at when you're starting up, and they can go across the board, not just in the UK, but if you look at it from a UK perspective. And the first three there around tax structuring and planning, tax residency, funding requirements, and also permanent establishment risk. These are the things that can be missed at the start of starting your business here in the UK. And what do I mean? Well, the UK tax system, particularly from a corporate tax world, can catch you in a number of ways. Now, the big thing that we see is that Fintechs think that, or companies think that actually just setting up a company outside the UK will mean they don't have a tax liability in the UK or a tax liability elsewhere in the globe. So particularly they might set up in BVI, the Caymans, Jersey, the archetypal tax havens that we've all heard about. However, that's typically, what I see, that's typically when people have had a chat with a friend who have done this, and they haven't really sought proper advice. Now, the reason I mention it is that in the UK in particular, and a number of countries in the world, there, just by virtue of incorporation, does not mean that you don't have a tax liability in a particular country. So in the UK, a company can be taxed for corporation tax purposes by virtue of incorporation in the UK. But the one that really catches people out is another way that you can be captured is if you have central management and control in the UK of that company. Now, what do I mean by central management and control? It's typically where are the strategic decisions being made? Where's the board sitting? What's the makeup of the board? Now, if the board is a majority UK-based people, then it is likely that that will be considered to be UK tax resident for UK corporation tax purposes. Now, that means that the entire profit and losses will be brought onshore into the UK if the UK revenue, HMRC, deem that company to be UK tax resident. Equally, if you're, say, incorporated in another jurisdiction, that doesn't stop that jurisdiction also taxing you in that jurisdiction by virtue of incorporation. So you could end up with a double tax. Now, there are means to limit that, typically under a double tax treaty. However, you normally have to go through a competent authority, so have to go through quite a painful process to agree with the two local tax authorities which country has taxing rights over that company. Now, that's not necessarily a straightforward process, and it does rely upon the two countries agreeing upon where that company really is resident. So the one thing to really watch out for is really plan up front. When you set up a company and you're looking at your business plan, business structuring, really think about where should I be and what are the tax implications of setting up in that particular country. Who's doing what where is usually my mantra. So that's usually whenever I speak to a fintech, it's like, okay, I understand your business plan, but who is doing what and where? So really think about that, because if you get the structuring wrong at the outset, then you might find that the founder's tax position becomes tricky and difficult because they might have a tax liability that they hadn't expected. But equally, and many of you will look for funding, so Series A, B, etc. funding, or you may look for an IPO or just an outright sale in the future. If you haven't got the structure right at the outset, tax so often comes in when people do their due diligence on a company and there is a tax liability that you weren't thinking about. So really here, it's just think about who's doing what where. Is it really how your future plans will look to develop? And is it the best place and the best structure for you? So really start thinking about that, because your companies, wherever they're incorporated, may not be where you're taxed. Similarly, whilst you have a tax residency issue that we've just talked about, that the whole company can be taxed, the other thing to consider is whether you have a permanent establishment. Now, this is a lower level risk. This is, do you have a trade somewhere else in another location? Now, this is, are you habitually concluding contracts in another location? Do you have an office in another location? So say you had someone undertaking work in France, but you had a UK company, there is a real risk that you have to look at what that French person is doing, because you could also be taxed subject to corporate income tax in France by virtue of a permanent establishment. So you really need to consider who's doing what, where again, and what are they doing in that location. Obviously with Fintechs, you're so mobile in terms of employment, employees, contractors, that they could be anywhere in the world. But just because of that, you do have potential risks that you may be taxable from a corporate point of view in those countries. You may also be taxable from a VAT point of view. But in particular, you do also need to worry about global mobility issues, because a person working in a particular country for you, you also may need, and you may also need to be an employee of record or employer of record in a particular country and deduct the equivalent to pay as you earn in the UK in those countries. So you may have employment tax issues by that person working in that location, corporate tax, VAT, as well as in that location, but as well as UK, because you need to make sure that you're not causing yourself to have double tax issues. So the real thing to take from this is just plan ahead. You grow so quick, the fintechs grow so quick that you need to make sure that you think about the planning and you think about where you're going to be in the future and what does that look like for any exit planning. Some of the other things on the list we're going to cover in a lot more detail. So I've highlighted there the VAT, the tax incentives and the tax risk management. We will cover those in more details because I think they're a lot more relevant and prevalent to you. As I say, in the UK, some benefits, some things to watch out for. Just on the other things to watch out for on this list, you've probably seen recently in the press about the OECD and the digital tax agenda. There is obviously moves afoot for those that have seen it and haven't seen it, moves afoot where essentially the taxation system is moving away from what I was describing in terms of residency and permanent establishment to really looking at can we tax it where your customers are? Now, corporate tax tends to be where the people doing the business are, not where your customers are. However, corporate tax is moving much more towards can we tax a company where those customers are? At the moment, the OECD have said that there's going to be a global minimum tax of 15%. However, this is the big however for you on the call. This global minimum tax of 15% is only for very large multinationals with revenues over 750 million euros. But you can, and so what they're trying to aim up is the Apples, the Googles, the Amazons of this world that are digital focused businesses that have, from the press's minds, limited their taxes by good structures so that they don't pay tax in particular countries. They want to make it a level playing field so that the Googles, Amazons, etc. of this world are paying a minimum tax of 15% and distributing that fairly to where their customers are and that country where their customers are. Shouldn't impact you as a startups, but it's one to watch out for, and you can see where the train of legislation is going. So it's one to keep an eye out, not one that probably impacts you just yet, but one to watch out for. That's all I wanted to say in terms of the common tax issues on this slide. And Reese, if you could just flick on to the next slide, thank you. Just a bit more housekeeping that I wanted to say, just in general terms, and I've said it before, but I keep on saying it, is just don't forget tax. When fintechs are so entrepreneurial, you're growing so quick, the founders want you to do want to do something now, yesterday, it can happen so quick that you just go and do something, but the basics can be forgotten. So when you go into a particular country or you've got a new product line, whatever it may be, I often find that companies are forgetting that they've got to just do the basics around tax compliance, and their finance function can't cope with the amount of responsibilities and all of the compliance that goes with the tax around the world, and it just gets missed. And if you miss it, you can end up with penalties, you can end up with interest, you can end up with huge amount of scrutiny from the tax authorities, understanding what you're doing, and it can just lead to time being taken out from a finance function to focus on tax issues that could have been dealt with early and not really focusing on growing a business, which is really what the finance function does in the fintechs. Or, and I shouldn't be saying this, or you spend a lot of money on advisors to try and resolve the issues that you've got, or making sure you're compliant. So just make sure that your finance and tax functions, in particular your finance functions as you start up, are ready and equipped to deal with the tax issues, and you plan your accordingly, and you also have your processes, people and systems in place to deal with the issues that are arising. That is a very, very quick canter through in terms of some of the real major high-level issues that I see. And, you know, just to take away, don't forget tax. Really think about your planning up front and get your structuring right, because it can be painful to try and unwind it. And when you're really thinking about where your tax liabilities are, it's really thinking about who does what and where. As you think about those, then you'll start to think about, oh, actually, we might have a tax issue because so-and-so is in a particular location, I may have a problem. So it's things to really watch out for, because it can come back and haunt you. Now there's some of the common themes that I see, but I really wanted to spend a bit of time with you just talking through some of the more detailed points that we see. And I'm going to hand over to Aditi Hyatt, who is going to talk you through some of the VAT issues that we see. Over to you, Aditi.
Thank you so much, David. Good morning, everybody. My name is Aditi Hyatt. I'm a VAT director, and I specialize in advising clients in financial services, including fintech. Reese, if we can move to the next slide. I would like to cover some of the key things that we are looking at and helping clients from a VAT point of view for fintech businesses. And in many ways, what we do in VAT effectively falls in two camps. One is the income, the second is the cost. Everything we do centers around that. So let's start with the income. One of the common areas where we often see HMRC effectively looking at the VAT liability of income streams is effectively twofold. Is the income stream subject to tax, or is the income stream subject to an exemption? In the UK, exemptions are very narrowly drawn. And what that has meant practically is there has been so much case law and policy in this area where businesses and the wider market have been looking at what does and does not fit within exemptions. And this has led to massive complications, particularly for fintech. We often see areas where HMRC query whether this supply or the kind of supplies that the business makes, should it be subject to VAT, or should it fall under any of the exemptions for financial services? One of the things we always advise our clients is to talk and think about tax, as David said, and think about VAT as soon as you're starting something new. The only reason is that the sooner you think about tax, the sooner you think about VAT, it's easier to do things properly and manage risks. So particularly when it comes to new services, new businesses, new operations, it's worth taking a pause and checking what am I actually doing? What do my income streams look like? Are they subject to VAT or are they subject to an exemption? What are the risks and how do I manage that? And the reason why it's important to understand what the VAT liability is, because it will also dictate two things. First is, if you are charging VAT, can your customers actually bear the cost? Or is that going to be an issue for them? Because that will have an impact in terms of how you're operating in the market, your pricing, your competition. So that's one side of things. The other side of things is the business's own ability to recover VAT on its costs. So in simple terms, if you charge VAT on everything, you should be able to claim back any VAT that you pay on your costs. But if you make exempt supplies, you can't do that. And that VAT that you spend on your costs becomes irrecoverable. So in view of this, it's very important to get the VAT liability right. Which brings me on to my next subheading, which is partial exemption. Effectively, when we work with clients, and particularly in the fintech sector, it's often we find that these businesses have part taxable supplies and part exempt supplies, which means that they can recover some of the VAT on their costs, but not all of it. And what we tend to do, and this is what we would recommend anyone starting business in the UK to look at, is to understand how they are consuming costs and how much can they actually recover VAT on their costs. Because the more you can't recover, the more is an absolute cost to the business in terms of its bottom line. Under the VAT rules, there are certain ways under which the law allows you to recover VAT. So there are certain default standard rules. However, if those standard rules are not suitable, so it gives you a result which doesn't make sense, the law also gives you options in terms of you can use alternative ways to actually improve your VAT recovery. And in VAT terminology, we call it a partial exemption special method. It's a very long sentence, it's a very long word, but all it means is if you don't like the general default rule, there are options to unlock more recovery. There are options to move away from the default and do something else. And that's where we work very closely with businesses to help them look at what can be done to unlock and maximize VAT recoveries. The one thing I would say is that these sort of options, when you consider, you need HMRC's permission to do that. And in practice, what we find is many fintech businesses, just by the very nature of what they're doing, it's very common for them to follow alternative methods only because a default standard method just doesn't give them the right result. One of the other things businesses hugely miss is looking at what costs that they have incurred and whether they are recovering the right amount of VAT. So we talked about some of the methods in place. But it's also making sure that if you have a cost item and if it wholly relates to a taxable supply, you should be able to get all of your VAT back. And you'll be surprised how many times businesses don't necessarily have the systems and processes in place to be able to capture that. And then what happens is a situation where, because the relevant data is not in place, businesses are not necessarily recovering the right amount of VAT that they should. The flip side is, again, if you have a cost which is wholly relating to an exempt supply, you shouldn't be able to recover any of that VAT. One of the things we found because of COVID and the strange world we've been living in recently, HMRC have introduced some simplification measures. And one of the measures is that for businesses who have followed alternative methods for recovering VAT, And if that method is not giving them the right result, particularly in a COVID environment, they can apply to HMRC to temporarily change that method. And it's a simplification, and HMRC are very quick to pick up on those things and help businesses. And it's an accelerated process. Another thing we often find businesses missing out is reverse charge. So I have 2 live clients where businesses haven't actually captured the fact that when you're buying something from overseas, they might be subject to VAT in the UK. And what that practically means is that often when, as a UK business, you're buying something from overseas, you wouldn't expect the supplier, usually overseas, to charge any VAT, but there's an obligation in the UK to charge yourself VAT. And it's a strange concept to charge yourself VAT, but the rules also allow you to recover either some or all of it. And many businesses actually miss that. And what that happens is you can have a situation where it's been years and years and nothing's happened. And then one day you wake up with an HMRC call and you realize you have £1 million liability or more. That's the worst nightmare. The other end of the spectrum is businesses where they have been accounting for reverse charge on services when in those circumstances they shouldn't have. And they are in a position where they could possibly get a refund because there are certain rules which allow you not to charge reverse charge in certain circumstances. So you can get a whole spectrum of businesses being in different situations. And it comes down again to David's point earlier, is all of this could just be avoided if businesses would think about tax right up front and make sure that before rolling out anything new, they're planning properly. Reese, would you move to the next slide? Thank you. I want to talk briefly about intercompany charges, and this is a huge thing in the UK VAT world at the moment, and there's a lot of focus. And you will see press on cases coming from HSBC, Barclays, they're all in the public domain. And the reason for mentioning that is because all these cases, the underlying theme is that HMRC are looking at how different companies within the same corporate group treat each other, and how they treat the VAT on these intercompany charges or intercompany services. And it's a massive gray area. So let me give you some examples. So we've already talked about reverse charges, but you get some really interesting conversations with clients where you have a UK business, but it's also got international operations. And the VAT treatment can be so different if you're working with an international branch or if you're working with one of your international group companies. And in one situation, there might not be any VAT at all. And in one situation, there may be. And to make things more complicated, sometimes that's not even the case. Again, it depends on various different rules. So I would recommend businesses think through properly in terms of how are the charges being made? What's the relationship between different entities and what that effectively is being treated for VAT purposes? Another point to think about is just making sure that anything that's being charged is at open market value. And that usually happens in situations where businesses can't recover all of that VAT, and it's just making sure that VAT is properly charged. I want to cover making tax digital very briefly. So for those who are not aware, these are new rules that have been brought in to make sure that businesses file their VAT returns digitally, but also there are rules in place now which require businesses to implement digital links. So have digital links across different records to prepare a VAT return. And this is meant to emphasize and ensure that everything is automated and there's a proper data trail. So when you're looking again from a UK VAT and you're registered for VAT, that's another top thing to consider. I've literally whizzed past through some of the key VAT topics. But again, I would just echo what was previously said by David is think about tax, think about VAT, particularly just managing things when you're starting new, because that's the best time to fix and do things properly. I will now hand over to Carrie.
Thank you, Aditi, and good morning, everybody. So I'm Carrie Rutland. I'm a director in the Innovation and Technology team. So that is R&D and Patent Box and other incentives that are available to companies and fintechs when they're coming to the UK. And Reece, do you want to move on to the next slide? So the government is committed to investing in fintech and encouraging fintechs into the UK. And we saw that at the budget, and we've equally seen that in a recent statement by Saron Khalifa and a project that he's done. So the aim is to make the UK the leading centre of fintechs in the world. And as part of this, several innovation incentives have been introduced and have been built on and expanded. And these are summarised on this slide. So at the early stage, when companies are building their products, and when they're coming to the UK, there are R&D tax credits and there are grants. When they start to commercialise their product or to make sales, there's the patent box. And then BDO can also help at the exit and the restructuring and the financing stage with our R&D benchmarking tool, which I'll talk about later. So Reece, if we want to move on to the next one. So the key incentive, the key attraction to the UK is R&D tax credits. And they're available to companies of all sizes in all industries. And they're worth somewhere between about 10% of your qualifying spend and 33% of your qualifying spend. So they're really worthwhile, really valuable. And you can access them if you're profit making or if you're loss making. So if you're loss making, they're cash generative. So the government will, well, the tax authorities will actually pay you a check to basically sort of subsidise that R&D that you're undertaking and encourage you to undertake more activities in the UK. Reece, do you want to move on? So I talked about the fact that R&D tax credits are worth between 10% and a third of your qualifying spend. And this summary just summarises what costs qualify. And you can see that the big costs that qualify for R&D tax credits are your staff costs and externally provided workers, box 5, which is typically contractors, or if you're moving to the UK, they could be other group staff who are working on a UK project and who are supervised out of the UK and recharged back to the UK. So the UK is very different from other countries in that respect, in the fact that worldwide costs that relate to an R&D project conducted out or led out of the UK can be included in the R&D claim. And so it's really important that you make sure you've established that audit trail to demonstrate that the leadership comes from the UK in order to bring those costs in. Reece, do you want to keep going? So how do you know whether or not you can make an R&D tax credit claim? Well, rule of thumb, I would say that probably every single fintech is eligible to make an R&D claim because you're all innovating in your particular area of fintech. You're all coming up with new software solutions. You're trying to do things faster, have a better user experience, do things at scale. So in 99% of cases, I would imagine you're eligible to claim R&D tax credits. So you're likely to be have some software developers building on new developing software applications, automating processes, improving processes, speed, performance. And as a result of COVID, there's been a massive move to digital, and fintech is leading in this area. So if you're not making an R&D claim, you really need to be thinking about it, because it's there to encourage precisely the type of work that you're doing. Reece, do you want to? Okay, so what do you need to do to make an R&D tax claim? And how can BDO help? So the key thing you need to do is identify your qualifying projects and be able to articulate them to the tax authorities in a way of support for your R&D claim, and to map your costs to them. And BDO has a team of software developers and engineers in-house that are all experienced in R&D claims to help you do that, and particularly to help you in that documentation phase of actually presenting a report to HMRC explaining why you're eligible to claim, what your project is doing and how it's innovative. And if HMRC are ever going to challenge an R&D tax credit claim, they will look at that project and they will look at that documentation, and that's their starting point. So it's absolutely vital that bit is got right. And as I said, we've got a team of engineers and software developers to help with that. Reece, do you want to keep going? I'm conscious I don't want to use up all of Martin's time, so I'm going to whiz through grants and just say that if you're moving to the UK, it's worth looking into what grants are available, either from an innovation side, so supporting your R&D processes, or from a capital perspective, so if you're setting up sort of facilities, operations, actual premises in the UK. So Reece, do you want to go on 2 more? So that's the capital grants, and we'll send these slides around afterwards. The other thing that is available to companies in the UK, and this is really of value to profit-making companies, but when you're building your technology, you should think about it. So we've heard about tax rates going up on a global basis and also in the UK. So tax rates in the UK are due to go up to 25%. What the patent box allows you to do is to reduce that corporation tax rate down to 10%. And all you really need is to patent something in your technology that's small and intrinsic. So that doesn't mean you have to give away all your trade secrets. It's finding something which is core to your product, which is relatively straightforward to patent, but which it pervades your product. So therefore, all the revenues generated from it will qualify for the 10% tax rate. So at the point of your developing your software before it gets into the public domain, either have a conversation with a patent attorney, and they're quite often happy to do it for sort of on a no fee basis, or let us know and we can introduce you to a patent attorney, just to say, is there something small and intrinsic which doesn't give away a trade secret that we can patent? Because then when you get to that revenue profit making stage, you're only paying 10% tax instead of 25%. So I think it goes back to exactly the same theme that David and Aditi have talked about a little bit of upfront planning on actually what activities am I doing in the UK, what people and costs are coming into the UK so that you can access R&D tax credits, and then is there anything I can patent to reduce the rate of tax going forward? And I'm now going to pass on to Martin.
Great, many thanks, Kerry. Cheers, Reece. Thanks. Can we just go on to the next slide, please? So, morning, everyone. My name is Martin Callaghan. I'm a director in BDO's Tax Assurance and Risk Management team. So, all of the work that I do and my team does relates to good governance, where there is a tax angle to it. So, tax internal audit, tax operating models, and so on. And I want to have a brief conversation today about why UK tax governance is important, and it's important. Well, there are three key areas that I want to run through. The firstly is how the importance of good governance in attracting investment for a business. So good governance and a culture of no surprises is increasingly important for investors. They want to know that tax risk within a business is minimized, and when considering that, they're looking at areas such as the UN's Principles for Responsible Investment, which set out clear investment criteria for consideration related to tax disclosures. So looking at areas such as tax policy, tax governance, risk management, and performance. And this isn't just an area that businesses are paying lip service to, it's an area of real importance. So it's interesting to note that earlier this year, Norge Bank Investment Management, who are responsible for the Norwegian government pension fund, actually withdrew investment in some businesses over their tax policies, citing a lack of transparency and information over where and how those businesses were paying tax. So strong governance, strong tax governance is coming up in investment due diligence. Secondly, we talk about reputation. Well, I'm sure you will have all seen the recent headlines concerning the Pandora Papers, which is a data leak of 11.9 million documents. But today isn't a discussion of the rights or wrongs of the matters disclosed in the Pandora Papers, but it does highlight two areas relevant to today's discussion, and that's the perception of what is right and wrong, the concept of paying your fair share of tax, and that's what hits the headlines. And that's one of the reasons the direction of travel in tax governance is for increasing transparency. And equally importantly, there's the increasing amount of regulation in this area. So there's already a raft of regulation in the UK related to tax governance, from the senior accounting officer legislation, the requirement to publish a tax strategy, business risk review, and also something called the corporate criminal offences legislation that I'll talk about shortly. And the direction of travel is for this regulation to increase as governments and tax authorities are increasingly effectively outsourcing areas of tax risk management to businesses. And I mentioned there the CCO legislation. So Reece, if we could jump on a couple of slides, I'll run through that briefly. So CCO legislation, it's part 3 of the Criminal Finances Act, took effect on the 30th of September 2017. So it's been with us for over 4 years now. And what this piece of legislation says is that if a representative of a business were to facilitate tax fraud, that business would automatically be guilty of a criminal offence. The criminal offence being the failure to prevent the facilitation from having taken place. Now, I'm sure you'll be listening to this and thinking, well, actually, it's highly unlikely that any representative of our business would facilitate tax fraud. So how is this relevant to us? Well, what I would say is the legislation is very broad in scope. If I run through the stages of it briefly, so stage 1, someone somewhere needs to commit tax fraud, deliberate and dishonest underpayment of tax. The important point to note is this relates to all areas of tax. So we're not just talking about corporate taxes, we are also talking about employee taxes, national insurance contributions, and also not just the UK taxes, but also the non-UK equivalents of those taxes. So that's stage 1. Stage 2, an associated person of the business or representative, the legislation refers to them as associated persons. The associated person of the business needs to deliberately and dishonestly facilitate that tax fraud. But again, the legislation is written very broadly. And this is also why it's potentially a particular relevance for fast growing businesses, because as those businesses grow quickly, they may need to seek to outsource various services that are provided as part of their operations. They may outsource, for example, some of the IT development or payroll or whatever. Well, under this piece of legislation, those third parties who are providing a service for or on behalf of your organisation are deemed to be your representatives. They're deemed to be your associated persons. And so the actions of third parties can nonetheless bring you within scope of a potential prosecution under this piece of legislation. And so you've got stage 1 tax fraud, stage 2 deliberate and dishonest facilitation of that tax fraud. And if those 2 stages are there, then the business is automatically guilty of a criminal offence, as I said, the failure to prevent the facilitation of the tax fraud. The downside of the legislation is significant. It will lead to criminal prosecution of the business. Clearly, if there are any regulators connected to the business, they will be, concerned about the activities that have taken place, and also it would lead to an unlimited financial penalty on the business. So that's all the bad news. What's the good news? Well, the good news, if we skip on a couple of slides, is that there is a defence in place under the CCO legislation, and that defence rests upon having reasonable prevention procedures. So these reasonable prevention procedures, they're based around these 6 guiding principles that are on the screen, ranging anywhere from ensuring the business carries out a risk assessment to having a CCO policy, carrying out training within the organisation, and importantly, carrying out due diligence in respect of those third parties with whom you do business, your business partners. They are actually all relatively simple to put in place. And so there is a good way. It's an important piece of compliance legislation. And we know, again, referring back to what I was saying before about investors looking at the governance of businesses, we know that investors in businesses are also looking at the CCO compliance within those organisations. It's an important piece of legislation. Potential downside is significant, but it's actually relatively simple to get the steps in place in respect of those 6 guiding principles. I mentioned that the legislation's been with us now for 4 years. So what activity has there been? And Reese, if we could skip forward another 2 slides, please. Yeah, sorry, another couple. Sorry, yeah. So what activity has there been? Well, HMRC are currently looking at 28 businesses, considering them for potential criminal prosecution. And what we know is that those investigations cover a broad range of businesses in the UK. So from the smallest organisations right up to some of the UK's largest businesses, and we know that because HMRC have issued statistics on their activity under the CCO legislation, and they've highlighted that one of the areas that in particular they're looking at, for example, is software development, which is clearly going to be important to a business that is that relies on software and high tech technology as part of their business model. So they are looking at lots of businesses, no prosecutions yet, but the head of CCO at HMRC, someone called Sam Dean, has said very clearly it is a matter of when rather than if. But importantly, looking at the slide that's on the screen now, we're also seeing increasing commercial activity related to CCO. So it's not just the risk of prosecution of a business, it's the fact that CCO is coming up increasingly in transaction due diligence. I'd probably at least once a week, once a fortnight, get a question from someone within transaction services, within BDO, to say that CCO has come up as a due diligence issue, and can we provide some assistance to the to our clients in that regard. I've seen CCO included within a bank's credit risk review process, i.e. it's part of the lending decision. Does the bank want to lend money to a particular business when there is a risk that business could be prosecuted under CCO if they've taken no steps towards compliance? And the final point there, we have seen it in one instance raised as a potential going concern issue as part of an audit. So CCO, been with us for 4 years, no prosecutions yet, however, significant levels of activity and importantly, significant levels of commercial activity, because having the right CCO processes in place, these reasonable prevention procedures, is also a reflection of the wider good governance that exists within a business. So if we then skip forward another couple of slides, please, Reese, and I'm going to talk very briefly about ESG. So what is ESG? Well, I'm sure we're all aware of ESG. It's in the headlines pretty regularly. It's an acronym that stands for environmental, social and governance concerns. The term was coined in 2006 within the UN's Principles for Responsible Investment. So it's been with us for a while, but absolutely is of increasing importance to businesses. An increasing number of stakeholders, including investors, are looking at the ESG profile of businesses. So you may ask, well, how does tax fit within that? Because typically when people think of ESG, they think of environment, climate change, social matters, inclusion, diversity, and also areas such as sustainability. But actually, tax does form an important part of the ESG agenda, and it's there within each element of the agenda, from environmental taxes, such as, plastic packaging, landfill, what we call behavioural taxes. They're about changing behaviours within organisations. It's there within the social element, so it's linked to the taxation, for example, of the gig economy, social taxes, and increasingly we're seeing within businesses a link between executive remuneration and ESG metrics. And finally, it's there very clearly within governance in discussions about tax behaviours, tax reporting, total tax contribution, and transparency. If we go on to the next slide, please, Reese, thank you. There's a fair amount of guidance out there as to what tax and ESG means. I've put a few examples there on the slide. I'll just talk briefly, firstly, about the World Economic Forum document. So towards common metrics and consistent reporting of sustainable value creation. Quite it trips off the tongue quite easily, the title of that document. So what has that got to do with tax? Prima facie, it's concerned with sustainability and a drive towards consistency of reporting. Well, within that document, it mentions tax 96 times, largely related to transparency measures. And to take a quote from that document, it says that there are increasing efforts to improve transparency around tax strategy, to demonstrate a shift from reporting compliance towards articulating why an approach is appropriate. So what does that mean? Well, you could say it's a move away from a very narrow and strict interpretation of tax law to a broader expression of purpose for businesses and how the approach to tax fits within that purpose. And having looked at each of those documents, we've distilled what that really means into 3 key areas. So Reese, if we skip on to the next and final slide, this is all about so I've already mentioned that there's a degree of tax governance requirements out there, which are generally but not solely for large businesses. But now we're increasingly seeing steps being taken outside of that framework and specific to ESG and responsible tax. So what does that mean? Well, firstly, are businesses talking the talk of responsible tax? So there's an increased move for publication of tax reports and tax strategies. And these strategies, which are sometimes published as standalone documents or as part of a wider sustainability report, these are linked explicitly to sustainability, ethics, and integrity. So does the tax strategy of a business fit within these wider concerns? And if organisations are talking the talk, are they also walking the walk? i.e., so it's imperative for those businesses to ensure that they have an appropriate governance, risk and control framework that stands behind the strategy. So if they're making statements around their risk appetite and their approach to tax and risk management, how does that actually work within the organisation? And this is often seen in the form of a tax policy document that will set out areas of expected behaviours across the tax function, and for also other areas within the business where tax compliance forms part of people's roles. And the final point there, again, transparency, an absolutely key element of ESG and tax or responsible tax. So this is most frequently seen now in the form of total tax contribution summaries. So this enables businesses to highlight both their tax paid and tax collected. So they can set out proactively their overall contribution to society and getting beyond the headline corporation tax number in their financial statements. And where the tax number in the accounts differs significantly from the mainstream rate of corporation tax, businesses are able to explain those material adjustments, such as, for example, losses brought forward. And I thought I'd just finish and summarise this with a quote from a tax transparency page of a large corporate that's published online, which I think sums up the concept of responsible tax quite neatly. And it states that we want to help facilitate more informed conversations with our stakeholders about our contribution to economic development, the part we play in society, and the rigour of our tax practices. i.e., we are responsible businesses, and our tax practices reflect that. ESG is on the agenda of most boards at the moment. It's certainly on the agenda for investment businesses, and so this is a great way for the tax and finance function to form a part of that conversation. And we finish there with just a couple of minutes left, onto, if we have time, some Q&A.
Thank you, Martin, and obviously thank you, Aditi and Carrie, for your parts of the presentation. They were really interesting, and I hope everyone else on the call found them interesting. As Martin said, we've got a couple of minutes left for questions. If anyone has some questions that they want to raise, if you can put it into the Q&A chat. We do have a couple of questions through. And so, but if you want to raise any more, please do. Maybe if we've probably got time for one or two. So maybe if I read some of them out, let me see if I can find those. So I can't see. There we go. Actually, Martin, it's one for you. Are there any examples of good practice in demonstrating responsible tax behaviours?
Yeah, absolutely. It's a good question, and that goes back to I guess what I was saying earlier about the ways in which some organisations are moving away from businesses that, for example, have an obligation to publish their tax strategy already online. There's a certain set criteria they have to meet, and traditionally and historically businesses have just taken almost a boilerplate approach to, well, there are these 4 things we have to talk about in our tax strategy, let's tick those boxes, get it done. Whereas now what we're seeing is a move towards more detailed reports going online, talking about risk appetite for businesses, talking about areas such as this total tax contribution. As I said, businesses being able to demonstrate that tax is an integral part of their approach to sustainability and good corporate citizenship. And we're certainly seeing the direction of travel is certainly in that direction.
Thanks, Martin. Yeah, I think, to reiterate that, Martin, I think, a number of fintechs that I talk to, as I said earlier, it's about getting processes, controls and systems in place, right, which is all about their tax governance piece. But it's about getting it right now. But as you said earlier in your presentation, I think it's, don't forget the future. Don't forget who might be wanting to, when you go out and fundraise, they will look, investors will look at what you've done, and especially in an IPO. We've got a couple of examples, haven't we, on IPOs where
absolutely
people have suddenly panicked around their tax policy, tax procedures, tax governance, CCO, not getting it right, and last minute having to put it in place. So
I think it's just the really important link between not just having good practice in place, but being able to very clearly demonstrate that good practice to any stakeholder that may have an interest.
Excellent. Maybe just time for one more question. I'm conscious it's 9:30, but we've had a couple more in, but maybe we deal with one. And Aditi, this one for you. How difficult is it to organise digital links under Making Tax Digital?
It's a really good question, and the short answer is it depends. There are some businesses with simple software which could potentially just capture all of the requirements, but there may be some businesses who are using multiple sources of softwares and spreadsheets to prepare VAT returns, in which case they need to think a bit more through how they're going to do those digital links. Starting point, speak with your provider, ERP provider, see whether they can help you. If not, we are always here to support.
Thanks, Aditi. I'm conscious of time. We're just, unlike normal presentations, we're only a minute over. So once again, I'd just like to thank the presenters for their words and great presentations, and for those listening, thank you for attending, and I hope you found it useful. Grateful for any comments that you have. We're looking to do this, as I say, as a series of countries. Please look out for our next series. We've got 4 or 5 other additional countries where obviously Fintech is a growing area in those countries, so we'll be rolling this out in the next, there'll be one every couple of months, so look out for that through LinkedIn or through your own contacts at BDO. For now, as I have no more questions, wish you all a good rest of the day, and thank you for attending and listening. Goodbye.